Hello everyone, it's Steve with Aptera Owners Club. Before I get into the meat of this video, I wanted to issue a correction. So Martin McNulty on Discord, as well as a few other people who contacted me privately, uh, pointed out a mistake that I made in the previous video. And it is, as Martin McNulty says here, in your video this morning, we were looking at the new filing and used the net loss number of 22.9 as your source of Aptera's current burn rate. But 15.7 million of that is stock-based compensation, which is a non-cash expense. Burn rate refers to how much cash the business is burning per month. A better way to understand burn rate is with the cash used in operating expenses from the cash flow statement. For Aptera, this is 7 million over the past 6 months. So Aptera's monthly burn rate is a bit over $1 million a month. That is to say, if we have $9 million on hand, that means that we have about 7 to 8 months of cash at the current burn rate. All right, so let's look at that. And this is, I looked into it and this is true. Many people have pointed this out to me. So this is from the S1 filing. If you look here, I was using this number, $22.9 million. But it is true, I did not look at this. Almost $16 million of that is stock-based compensation. That's like giving options or giving stock to vendors and to employees. If you look at net cash used in operating activities right here, it's $7.1 million. So they used $7.1 million over the 6 months ending in June of 2025, which means their monthly burn rate for that most recent period is just slightly over $1 million a month. So with $9 million, we're looking at probably about 8 months of runway if they don't raise any more cash at their current cash burn rate. Okay, so that's just wanted to make sure that is very clear to everyone. So after the previous video where Aptera went through a direct listing, so this is the SEC website on the difference between an IPO, a SPAC, and a direct listing. So as we know, an IPO is where they get an underwriter and a investment bank, and they get the underwriter's assistance in marketing and managing initial trade volume. And then SPAC is basically they use a shell company that goes IPO, and then the SPAC company merges with the company, and then that SPAC company stock becomes your stock basically. And then direct listing. So this is what Aptera is doing. What is it? A private company becomes public typically without raising new funds in the process. That is what Aptera is doing. If they issued new shares that they're going to unload at the time of listing, that is called a hybrid direct listing or direct listing with capital raise. That is not what Aptera is doing. Aptera is just doing a direct listing, but I highly suspect at some point down the line, they will issue more shares and raise capital that way. That's just my guess, but I think it's a good guess. A private company becomes public typically without raising new funds in the process by allowing existing shareholders to sell shares directly to the public. So we are the existing shareholders as well as the employees of the company and possibly previous employees of the company if they've been vested before they left, as well as a lot of their vendors and partners and stuff like that. They own stock. Okay. Historically, a few very large consumer-facing companies have chosen this path due to potentially lower transaction costs and other business-specific reasons. So historically, very large companies that have a large consumer base and good name recognition go through this. That is kind of changed recently. I'm going to go over that. What to consider. With no underwriters involved, companies will have no control over their initial investor base and may face trading volume challenges, which is why companies that choose this path are often ones that have strong brand recognition that can generate sufficient market interest. This is going to be key for Aptera. We know about Aptera, but I think Aptera is not very well known. And my suspicion is that Aptera does need to do a lot of marketing and perhaps do this road trip that they're talking about with Artemis to generate lots of media exposure and brand recognition so that when the public direct listing actually happens, there will be people that are interested in buying. I think that's what they're going to need. Okay, so I kind of wanted to know what the recent history of direct listing companies are. And so I found this guy, Jay Ritter. He is a professor or emeritus professor. I think he retired last year from University of Florida. And he basically, let's see here. Okay, yeah, this is his page. Okay, he has a page. This is his like personal web page at University of Florida's College of Business. And okay, I'm going to make this bigger for you so people can see it. Okay. All right. So he has a whole website about IPO, and he's known as Mr. IPO because kind of that's his specialty in the finance school. And so he has like all this information about all the recent IPOs. And the one that was interesting to me was this one right here, IPO direct listings. So if you look at that, you come to this 4-page document that he created. So he kind of did all the work that I was trying to do. I was going to look up some of the, I was going to try to look up all the direct listings that were done recently, but he's done them all. And so here is a list of all the companies that underwent direct listing. So you'll recognize many of these companies: Spotify, Slack, Watford Holdings, Asana, Palantir, Thrive Holdings, Roblox, Coinbase, Squarespace, ZipRecruiter, Amplitude, Warby Parker, Bright Green, Surf Air, Courtside, Realpha Tech, Fibrobiologics, Clouda Structure, Neo-Onc Technology Holdings, and Arrive AI. So this is direct listing date. This Spotify was 2018, all the way up to the most recent Arrive AI in, what is that, May of 2025. Okay, and then he shows what their reference price was, what it opened at on that day, and then what it closed at that day, and what it did on the first day of trading. So most of these lost money on the first day of trading. Bright Green being an outlier. This, I think, is a mistake. This $406 close. I looked back at this, and that is not what it closed at. It closed at close to 23. But I think so. Most of these are down a little bit, and even Palantir was down 5% on the first day of trading. Then they wanted to see what this was kind of more interesting to me, is intraday volatility and trading volume. So if you look at this, the companies with lots of recognition obviously have huge trading volume. So like look at Palantir Technologies, 340 million in trading volume on the first day. And then Slack, 140, Spotify, 30 million, Roblox, Coinbase, those are huge. ZipRecruiter, we've heard of them. Squarespace, Warby Parker, these are all companies we've heard of, or at least I've heard of them. And so I was more interested in the smaller companies because that's who is going to be similar to what Aptera is not going to have the name recognition of like Slack, Spotify, Coinbase, Roblox, Squarespace, ZipRecruiter, that kind of stuff, or Warby Parker. They're going to be one of these smaller ones. So the smallest ones I found were like Thrive Holdings, Realpha Tech here, and then I looked at the most recent one, Arrive AI, because I thought there were some fun parallels between Arrive AI and Aptera. So let's look at this. Oh, just quickly. This is Jay Ritter. This is his CV, so you can tell he got a bachelor's and master's in economics at University of Chicago, and then a PhD in economics and finance at University of Chicago. University of Chicago is a economics powerhouse. If you guys are not aware, they are one of the top schools globally in economics. Tons of Nobel laureates in economics at University of Chicago. I heard it's a pretty intellectually rigorous environment. Like people just basically call you out if you're wrong publicly, and publicly name and shame you. So it's a tough place. Anyways, that's where that guy's from. Okay, so here is I want to talk about Arrive AI last, I think. So this is Thrive Marketing. This is basically, if you look at Thrive Holdings, this is their website. They run some kind of software as a service business to help small businesses like do marketing, do social media, do leads, do search engine optimization or reputation management. So kind of like an all-in-one software platform. They had like uh, several, I think 20,000 customers when they went IPO. So here they went IPO back in 2020, and you can see they've been around for 5 years, and they're pretty stable. They peaked out at like 40, and they're back down to 20, so they're kind of back to where they started when they went off the holding. So and their market cap's about 500 million. Um, but that's what they're doing. And then there is this company called Realpha Tech. They look like they're some kind of software company that's trying to make uh, real estate transactions more efficient for home buyers. So they're going to do like the title insurance, the sale, the mortgage, all together. I didn't really understand their business model, but I have many thoughts about the real estate business in America. I think it's very inefficient the way they run it with agents and stuff. But I digress. So if this company is doing something to make it more efficient and get a middleman out of the real estate business, I think it's probably a good thing. But you can look at their things. See, they didn't close at 400. Remember, this paper said that Realphatech closed at $406 and gave themselves a 2,000% first day return. That it does not look like it's true. If you look at this, they closed here at 23.17, and then this company kind of dropped like a rock over the first couple of months and then stabilized around $1 a share. And remember, if you stay under $1 a share, you get delisted from NASDAQ. So they're currently still listed on NASDAQ. So they've been floating around $1. And then the last like couple of months, they've been under $1. So I suspect they're going to undergo a reverse stock split just to keep themselves from getting delisted from NASDAQ. So this is a very small company. Their market cap is only 30 million. And then I just wanted to talk a little bit about Palantir because I've been following them. Palantir Technologies, if you don't know, they've had kind of a tear. If you bought them in early 2024, you could have gotten them for you had 10x returns. They were at $15 a share back then. They're $158. They peaked out at like 190. Yeah, there you go, 190. A while back. This is a software company that does a lot of governmental work with like defense and civil management. I don't know if you've heard in the news. So here's Palantir Technologies website, automated decision making. They basically a data artificial intelligence company. They basically they were tapped to like start a huge database on every U.S. citizen, and they can pull data from like every Department of Labor, IRS, defense, like Veterans Affairs and everything. And they were going to make like a giant database of every citizen in the United States and then run analytics on it. And they were also building a platform to have help ICE like track immigrants in real time. And so like it's been politically a little bit controversial, but because of these things, their stock has been doing extremely well over time. And they went IPO via direct listing in 2020. So they were offered at like $10. That was their reference price. They went down to like 920 on the first day, but generally, and they were kind of below that in 2 years. But wow, they just really took off uh, recently. All right, so um, let's go back and look at Arrive AI. Arrive AI is basically a company that, as far as I can understand, they have like smart mailboxes and they'll have drones like deliver you stuff. So they're saying that they're gonna their technology is better than like what Amazon is doing and stuff. So seems like a very interesting company and interesting technology that they have. So yeah, they're basically having these smart mailboxes that you can like just go to and pick up your packages and stuff. Um, what was interesting to me is if you look at their stock, they underwent a reverse stock split. Yeah, right here. See, reverse stock split. Aptera just underwent a 1-to-3 reverse stock split. This company underwent a 1-to-4 reverse stock split right before they um, went public via direct listing. And so if you look at this, reverse. Okay, well, anyways, they went through a reverse stock split and their crowd, so they went through 3 rounds of crowdfunding, very similar to Aptera. They underwent a reverse stock split, except theirs was 1-to-4. So if you had 400 shares of Arrive AI, you had 100 shares of Arrive AI before they went uh, public through a direct listing. So that was a bigger reverse stock split than Aptera went through with a 3-to-1. And then their stock price, when their last stock price, they were selling around $13 a share. That's accounting for the 4-to-1 stock split. And if you look at their performance, they hit the market at like $10 a share. So if you bought at 13, you kind of lost a little bit of money. And then they dropped down to 5, and then they went up, and they're like down to 5 again. So that's kind of been their trajectory over time, and their market cap's about 200 million. So there is a big history of companies going IPO via direct listing, and many big names have done so. And the volatility on the first day is not as high as I expected. I thought the volatility of direct listings would be much higher. Now, of course, the volatility of these big companies is going to be less because there's going to be a lot of people trading shares. So, but like this Thrive Holdings, they only had volume of 9,000 on the first day, and their volatility was not that high. It was only 30%. Um, this volatility is obviously wrong because these numbers are incorrect. But it looks like the biggest volatility was Arrive AI, and they basically they hit the market at 11, then they went up to 40 intraday, and they ended up at 13, and so that's a 200% swing in the first day. And then Bright Green, they also had like a 80% swing on the first day. Fiber Biologics, 100% swing on the first day. So those are relatively small volume companies. So I'm expecting Aptera to be in this range, like 50 to 100% swings on the first day. But I have no idea. I could be totally wrong. I've misjudged stock performances my whole life, basically. And I've rarely been right about anything when predicting stock prices or volatility. I just like to make predictions and be completely wrong about them, I guess. Um, but yeah, I will put this web page, Dr. Ritter's web page, in the description, and you guys can check it out. Lots of fascinating information about IPOs that Dr. Ritter has done, and then you can find this document and peruse it for yourself. But it just goes to show you many big, well-recognized companies go through this direct listing. For the most part, it has worked out well for them as companies. Has it worked out well for the stockholders? I would say, I mean, if you're a Palantir stockholder, yeah, it worked out great for you. I didn't look at like Roblox and Coinbase and stuff. I suspect that they're also doing well. These smaller companies, they've been kind of hit or miss. Arrive AI, people have lost about 50%. And Alpha Tech lost a lot, actually. They started at 10 and they're down at like 50 cents a share or 30 cents a share. They've lost a lot. So, I think the direct listing route in and of itself doesn't predict the performance of the stock. It's different by company. So companies that are strong and doing well, their stock is going to do extremely well, and companies that are struggling or less well known, they're going to not do so well. And then what was most surprising to me is like even very small companies with low volumes did not have extremely high volatility. I thought maybe there'd be like 1,000% volatility, but there just isn't that. It just the upper end seems to be about 100 200% volatility on the first day, and then it tends to generally stabilize out. All right. So, and then I also thought it was super interesting that Arrive AI had almost a very similar course as Aptera, where they underwent a reverse stock split like a few months before they underwent direct listing. And overall, they're doing okay. They're doing okay. And it did not seem like it hurt the crowdfunding people that badly to do the reverse stock split. They people bought their during depending on which crowdfunding round was, it was like a few dollars a share up to $13 a share, and at the end of the first day it was trading at like $13 a share. So that's after the reverse stock split. So um, seems like people made out pretty well with them. Okay. All right. Thanks for watching, guys. Hopefully that was helpful to you guys. I learned something looking into this, and I found this webpage very fascinating. So go check it out if you get the chance. Have a great day.